The Engines of Innovation, a comprehensive guide to the iShares Russell 1000 Growth ETF, IWF. As of February 8, 2026, the iShares Russell 1000 Growth ETF, ticker IWF, remains one of the most critical barometers for the U.S. innovation economy. While the market has seen significant shifts, including the massive AI build-out of 2024 and 2025, and the subsequent stabilization of interest rates in early 2026, IWF continues to be the primary vehicle for investors who want broad, diversified exposure to companies with above-average growth potential. For a beginner or an experienced investor looking to reevaluate their portfolio today, IWF represents a high-octane core holding. It isn't just a tech fund, it is a collection of nearly 400 companies that have proven their ability to grow revenue and earnings faster than the rest of the market. This 1,500-word guide explores the mechanics of IWF, its sector-defying resilience in the 2026 economic landscape, and how it compares to its rivals. 1. What is IWF, the growth vanguard? IWF is an exchange-traded fund, ETF, that tracks the Russell 1000 Growth Index. To understand IWF, you first need to understand the Russell 1000. This index represents the 1,000 largest publicly traded companies in the United States. The growth version of this index filters those 1,000 companies to find the ones that exhibit the strongest growth characteristics. Selection criteria. The index uses a multi-factor approach, looking at IBES forecast growth, what analysts expect for the next 2 years, and historical sales per share growth. The tilt. Unlike a standard S&P 500 fund that buys every large company, IWF only buys the fast movers. This gives the fund a natural tilt towards sectors like technology, communication services, and healthcare. 2. The 2026 economic backdrop. Why growth matters now. In early 2026, the narrative of the higher-for-longer interest rate environment has finally shifted, with the Federal Reserve having initiated a series of measured rate cuts throughout late 2025. The growth segment of the market has found a new tailwind. Current 2026 market dynamics. The AI maturation. The AI hype of 2023 has evolved into the AI implementation of 2026. Companies in IWF are no longer just talking about AI, they are showing significant margin expansion because of it. Stable valuations. While IWF still trades at a premium compared to the broader market, with a price-to-earnings (PE) ratio of approximately 43.9x as of early 2026, this is supported by double-digit earnings growth forecasts. Capital expenditure trends. Large-cap growth companies are currently sitting on record levels of cash, allowing them to outspend smaller competitors on research and development (R&D). 3. Inside the portfolio, the magnificent dominance. IWF is a market cap-weighted fund, meaning the bigger the company, the more space it takes up in the portfolio. In early 2026, the concentration in the top 10 holdings is significant, representing roughly 59% of the total fund. The top 10 pillars as of February 2026. Nvidia, NVDA, 12.7%, the undisputed engine of the AI hardware revolution. Apple, AAPL, 10.8%, now a leader in edge AI and high-margin services. Microsoft, MSFT, 9.2%, the dominant force in enterprise software and cloud computing. Amazon, AMZN, 4.8%, combining retail dominance with the high-margin AWS cloud. Broadcom, AVGO, 4.6%, a critical player in networking and infrastructure. Meta Platforms, META, 4.6%, leading the world in digital advertising and Llama-based AI. Alphabet, GOLGO, 6.8%, combined. The operating system of the internet. Tesla, TSLA, 3.7%, moving beyond EVs into autonomous robotics and energy storage. Eli Lilly, LYLY, 2.8%, representing the healthcare growth story via GLP-1 weight loss breakthroughs. Investor note. When you buy IWF, you are essentially making a bet that these 10 companies will continue to dominate the global economy. If they succeed, you win. If they stumble, the fund will feel it. 4. Sector breakdown. Beyond the tech fund label. A common mistake is assuming IWF is just another tech ETF. While technology is the largest slice of the pie, IWF provides exposure to growth across the entire economy. Information technology, roughly 50.6%, the brain of the fund. It includes software, semiconductors, and hardware. Consumer discretionary, roughly 13.3%, includes giants like Amazon and Tesla, as well as luxury retailers and travel companies that benefit when consumers feel wealthy. Communication services, roughly 12.1%, home to Meta, Alphabet, and Netflix. This sector is the primary vehicle for the attention economy.
Healthcare, roughly 8.1%. This is where IWF finds defensive growth. Companies like Eli Lilly and United Health offer growth that isn't as tied to the economic cycle. Industrials, roughly 5.6%, featuring companies like GE Aerospace and Uber, which are using technology to revolutionize traditional industries. 5. Financial profile and cost analysis. For many investors, IWF is the Goldilocks of growth funds, more diversified than the Nasdaq 100, but more aggressive than the S&P 500. Key statistics as of February 8, 2026. Expense ratio, 0.18%. This means you pay $18 per year for every $10,000 invested. While not as cheap as some Vanguard options, it is highly competitive for a specialized growth fund. Net assets, roughly $120 billion. This massive size ensures that bid-ask spreads are tiny, making it easy to buy and sell without losing money to transaction costs. Dividend yield, roughly 0.33% to 0.37%. Growth companies usually reinvest their profits rather than paying them out. Don't buy IWF for the income, buy it for the capital appreciation. Beta, roughly 1.15 to 1.43%. This measures volatility. A beta over 1 means IWF moves more than the broader market. If the S&P 500 goes up 10%, IWF might go up 12%, but it also falls harder during downturns. 6. The competition. IWF, VUG, QQQ. When choosing a growth fund in 2026, you will likely encounter these three names. Here is how IWF stacks up. IWF, the balance specialist, tracks the Russell 1000 growth. It holds roughly 390 stocks. It is more diversified than QQQ and less tech concentrated than VUG. VUG, the Vanguard Growth, the low-cost leader, tracks the CRSP US Large Cap Growth Index. It is significantly cheaper, 0.04% fee, and holds fewer stocks, roughly 160 stocks. It is a purer play on the absolute largest growth giants. QQQ, Invesco QQQ, the tech specialist, tracks the Nasdaq 100. It is the most concentrated, with nearly 60% in tech and communication. It has a higher fee, 0.20%, but has historically offered the highest returns during tech bull markets. 7. Critical risks for the 2026 investor. Growth investing is not for the faint of heart. Before putting your first dollar into IWF, you must understand the risk profile. Valuation risk. In 2026, growth stocks are not cheap. You are paying a high price today for profits that might not arrive for 5 or 10 years. If those profits don't materialize, or if they grow slower than expected, the stock price can re-rate downward. Concentration risk. As mentioned, nearly 60% of IWF is in just 10 companies. If a regulatory disaster hits Apple, or if Nvidia faces a sudden drop in chip demand, IWF will struggle even if the other 380 companies are doing well. Interest rate sensitivity. While rates have stabilized in 2026, any unexpected inflation that forces the Fed to raise rates again would be toxic for growth stocks. Higher rates make future earnings less valuable in today's dollars. The value rotation. In early 2026, some institutional money has begun flowing back into value stocks like banks and energy. If this trend accelerates, IWF could enter a period of prolonged underperformance. 8. Strategy. How to build with IWF. How should you use IWF in your portfolio? Most 2026 investment strategies fall into two categories. The core growth layer. Use IWF as 20 to 30% of your total stock portfolio. This gives you a growth engine that sits alongside a total market fund like VTI or VOO. The satellite tilt. If you already own a balanced portfolio but want to tilt toward the winners of the AI age, you can add a smaller 5 to 10% position in IWF to capture that upside. The dollar cost averaging, DCA, rule. Because IWF can be volatile, don't try to time the market. Instead, invest a fixed amount every month. In early 2026, this strategy is particularly effective because it allows you to buy more shares when the tech-heavy market dips and fewer when it is at record highs. Conclusion. The future is a growth story. The iShares Russell 1000 Growth ETF, IWF, is more than just a ticker symbol. It is a direct investment in the ingenuity of the American corporate landscape. As we navigate the complex economic waters of 2026, IWF offers a transparent, liquid, and powerful way to own the companies that are defining the next decade. It provides the scale of the world's largest giants with the agility of the mid-cap disruptors. The verdict. If you are a long-term investor with a time horizon of 5+ years and the stomach for occasional 20% drops, IWF is a premier tool for building wealth. It is the definitive way to ensure you never miss out on the next great American growth story.